You make your debt payment every month, then check the balance expecting to see real progress, and think, that's all it went down? Month after month, you keep paying, but the debt barely seems to move. I'll show you where your payment is actually going and the change that can help more of your money start reducing what you owe. The first thing to understand is that your entire payment doesn't necessarily reduce what you owe. Here's why. Suppose your debt payment is $500. You send $500, so naturally you expect your balance to drop by $500. But when you check the statement, maybe the balance only went down by $325. That missing $175 didn't disappear. Part of your payment went toward the cost of borrowing the money. That's interest. So before you can understand why your debt seems to be moving so slowly, you need to look at your payment as two separate pieces: interest and principal. And only one of those pieces actually reduces the amount you owe. Principal is the amount you borrowed and still owe. Interest is what the lender charges you for borrowing that money. When you make a payment, part of that payment may cover interest and the rest reduces principal. Let's use a simple example. You owe $10,000 on a debt. Your payment is $500. If $175 of that payment goes toward interest, only $325 reduces the principal. So after making a $500 payment, you don't owe $9,500. Ignoring any other charges or transactions, you owe about $9,675. That's the moment that creates the "that's all" reaction. You paid $500. But your debt only fell by $325. And there's something important about that $325. Reducing principal can also change what happens to future interest. Interest is generally calculated using the amount you still owe and the terms of the debt. So when the principal stays high, interest continues to take part of the money you're sending. That can make progress feel painfully slow. That's why interest doesn't just cost you money, it costs you time. The longer a large balance remains, the longer interest has an opportunity to keep adding to the cost of the debt. That means the balance can take longer to eliminate than you might expect, and over time you can send considerably more money to the lender than the amount you originally borrowed. But this is also where understanding principal gives you something useful. Because if you can reduce principal faster, you may be able to change how much future interest the debt costs you. It's important to check with your lender so you understand the terms of your loan and how extra payments are applied. We'll come back to that in a minute. And that's the part one want you to see, because making a payment and attacking the balance are not always the same thing. Start by finding out exactly how your payment is being divided. Look at your most recent statement. Find three numbers: your current balance, the interest charged, and the amount of your payment. If you have a loan with an amortization schedule, you may be able to see exactly how much of each scheduled payment goes toward principal and interest. For a credit card, the calculation can work differently, but the principle is the same: interest costs money that could otherwise be reducing your balance. Once you understand that, the goal becomes clearer. Keep making at least your required payments, but before putting additional money toward the debt, find out exactly how that extra payment will be applied. Check your lender's terms and make sure additional money is actually reducing principal rather than simply changing the timing of a future payment. Once you know how your lender applies extra payments, the goal is simple: when your budget allows, send additional money that goes directly toward principal. That reduces the balance faster, which can reduce the interest you pay going forward and allow more of your future money to attack the debt. If you have several debts, interest rates also matter. Higher rate debt generally costs more to carry, so directing extra payoff money toward higher interest balances can reduce interest costs faster, while continuing to make the required payments on your other debts. The important change is this: don't judge your progress only by how much money you sent. Watch how much principal you actually removed. Because that is the number that tells you whether the debt itself is shrinking. Here's where I would start. Take one debt, not all of them, and pull up the latest statement. Write down balance Interest rate. Payment. Interest charged. Principal reduced. Beth sees that $325 of her normal payment is reducing principal. Then she looks at her budget and finds another $75 she can put toward the debt. Before sending it, she checks how her lender handles extra payments. If that additional $75 is applied to principal, she has now reduced the balance by $400 instead of $325 in this simplified example. That lower balance can mean less interest going forward, depending on the type and terms of the debt. And that's where the cycle can begin working more in your favor. Lower principal, less interest, more opportunity to reduce principal, faster progress. You don't need to memorize a formula. You need to know how much of your payment is actually reducing what you owe, and what options you have for increasing that amount. So the next time you make a debt payment, don't look only at the amount you sent. Look at how much principal disappeared. That's the number showing you the progress you're actually making against the debt. Money saving tip: usually, the more you pay toward principal, the less interest you'll pay over the life of the loan, and the faster you can pay off the debt. But like I said, check with your lender first to make sure you understand how extra payments are applied. And once you understand how to make more of your money work for you, there's another trap to watch for: what happens when your income actually goes up. But getting a raise doesn't automatically mean you'll have more money left. Next, we're going to answer, you got a raise. So why don't you have more money?